Today's is a very special episode as you're joining us in a live video link between London and my hometown, Terrigal, in New South Wales, Australia. Hi, I'm Paul Mahoney and this is Proper Wealth, the show where we discuss all things wealth creation, including property. Joining me today is Richard Campo from Rose Capital Partners. We're going to be discussing the UK residential mortgage market, some of the changes that occurred, where the market's going, and how individuals can use it to help them.
I suppose the major change with residential mortgages recently is the Bank of England increasing rates. So on the 2nd of November, I believe, they put the benchmark interest rate up to 0.5%. Which was previously 0.25. So naturally that's had two impacts. Mortgage rates have risen off the back of that. So you're typically going to find your average mortgage is around about 0.25% more expensive. Secondly, it does change the dynamic of the industry. So that's the first base rate increase we've had for over 10 years now. So anyone in that period has never experienced a base rate rise, which is the majority of mortgage owners in this country. So if you haven't been familiar with this before, which obviously most people haven't, I remember when I started in mortgages in 1999, it's quite common that rates went up and down. So what you'll probably find going forward is the market moves faster. Banks are quicker to move their pricing. You often might miss out on deals. Certainly something we've seen in the last 2 years is there's pretty much been a downward trend on mortgages. So people looking around for property in the last 2 years, it's not a short period of time. If they come back and review their mortgage at a later date, it's normally cheaper than it was before. That trend is completely reversed. So really from this point forward, mortgages will only ever get more expensive. There's been a lot of guidance from the Bank of England, so they think it's going to be a very slow, gradual movement going forward. The new normal on interest rates will be roughly around 3%, whereas historically it was sort of 5%. And they think it will probably take anywhere between 3 to 5 years to get to that point. The big sort of elephant in the room really is Brexit. So again, there's been one base rate rise now. It's quite likely we'll pause for breath now to see what the outcome of that was, but then it will move forward. So like I said, that trend of interest rates going down has really stopped. That's probably the big one. The other bits and pieces, the major other change I think we've seen is the stamp duty changes in the budget. So for first-time buyers now, up to £300,000, there's no stamp duty to pay whatsoever, which is a great holiday. I think that's going to be reviewed in the next budget in April, but certainly for that period, there's no stamp duty to pay whatsoever. We're based in London, so there's a bit of dispensation for that. So if you're in a sort of a more affluent area or certainly more expensive area, if you're buying between 3 to 500,000, you only pay the difference. So again, that's only specifically for first-time buyers. Typically that will save most people up to £5,000. That's really quite significant. And again, I think if you put those two factors together, so you've got now a lot more first-time buyers with a bit more cash to move, certainly incentive to move if nothing else, and a rising interest rates, I think that's going to start the market moving forward with a bit more, certainly momentum than it had previously. Also another dynamic we see, maybe more so in London and certain other urban areas you'll find, is that because you've got first-time buyers coming back into the market, that frees up first-time movers. So what that'll probably is a bit of a chain reaction up and down the market. Now it's a bit easier to move.
Very interesting, Richard, with regards to obviously the change in direction of interest rates. And as you say, a lot of people have never experienced that before in their life as mortgage owners. And then also the change with regards to first-time buyers. I suppose that's going to have a bit of an impact on the lower end of the market. Those buying under £300,000 obviously are able to take advantage of that change. And that's very much in line with some of the other changes with regards to buy-to-let recently. So potentially a bit more buying pressure on properties that are sub 300,000. There's been some talk in the media recently around a fear factor with regards to rising interest rates and more regulation in the buy-to-let world. It's not something I necessarily agree with the logic of, in that I think there's some great opportunities in the market at the moment. In fact, outside of London, the property market is very much moving forward. But I'd be interested to hear your take on that. Do you think there's a fear factor in the market at the moment?
I wouldn't say fear factor is the right way to phrase that. I think it's just we're on an upward curve on rates. It's going to be fairly slow. I understand certainly the trepidation around Brexit, and people are fearful of what might happen. I mean, I'm not a political commentator, and I'm certainly not an economist, so I can't tell what's going to happen with that. If you look at just the fundamentals of the market, which is really the key thing, so what's changed, Brexit or without Brexit, in this country, and specifically in any urban area in the UK you can look at, there's a chronic lack of property. It just has been for a very long period of time. So a fear, I don't really get what that fear is, because what's the fear? What, house prices go down, rates go up? Rates will go up very, very slowly, and there should be a very sort of stable rise up there. If house prices dip, well, it's like any market. If you just look on the land registry data, it's actually sort of really quite interesting if you do play around with that. I don't think in London specifically, is a figure I know, I don't think there's a period in history where if you look over a 10-year window, house prices haven't doubled in London. Now, it's not true the same with the rest of the country, because obviously there's a huge amount of demand in London, but certainly that level of growth over a 10-year window is true, so I don't see what changes with that. In the short term, there's ups and downs, so it's like any market, but fear of a crash or anything sort of catastrophic, I think it's a long way off the mark, because there's just simply not enough property.
Absolutely agree with you there, Richard. It should all come down to the fundamentals, and at the end of the day, the UK housing market is massively undersupplied. We're nowhere near meeting the supply requirement on a yearly basis, and whilst ever you have that sort of very basic fundamental, the property market will remain strong. With all these changes that are happening recently though, I'm a big believer that there's a massively growing need for advice, whether that be buying property or getting mortgages, which obviously relates to you. What's your feelings on that?
Yeah, 100% people need advice, because I think there's sort of, again, two sort of major aspects of this. So why people need advice is you need to think about who works for you. If you go to a bank, you've got a bank advisor who works for the bank, it seems very logical. And what they're not going to do, if you walk into the door of Halifax, they're not going to tell you Santander has the best deal and vice versa. So banks don't ever have incentive to tell you their competitors are doing better. That's logical. You can even go one step further. So if you want to sort of compare, which a lot of people do, so if you want to play around with the meerkats or the guy with the dodgy moustache, that's completely cool. Worse than mine, I think, actually. You can do that, but that will tell you what the cheapest deal is, but it's not advice. Is that the best deal for you? Is that the best outcome? Really simple example I can give you is aeroplane flights. So do you book the cheapest flight available? Most people don't, because it's a really inconvenient time. It doesn't get you exactly where you want to get to. Mortgages are the same. Sometimes you want to pay a little bit more for getting the right outcome. So that's why that advice bit is really important. And any good financial advisor or broker works for you, the client. That's why they'll advise you. Also, as well, is once you've established a debt, you utterly need to protect it.
Thanks, Richard. That's all very interesting. My next question is with regards to residential mortgages, whether they can be used to invest in buy-to-let. So essentially remortgaging your home to invest in buy-to-let, a fairly age-old strategy that people have been using for a long time, especially when they're first getting started. Has there been any changes in that market recently, and what's your take so far as actually doing that as a way of getting started in the buy-to-let market?
Well, I mean, yes, you can raise some capital from your main home to buy a buy-to-let. There's absolutely nothing stopping that, as long as you have the amount of equity and can afford the loan. It's like any market at the moment, it is a lot more complex than it used to be. The biggest change is what we call stress tests. So what a bank used to do is really simple, is as long as your rental payment, was about 125% of your mortgage payment, banks were happy to lend. Obviously in a low interest rate environment, as I mentioned already, rates will rise in future. Banks apply what's called a stress test. So a really simple scenario is, whatever you're borrowing, most banks assume a rate of around about 5.5%. They times that figure by about 145%, and that's what your rent should equal. That can be quite tough to borrow, say, like 75% on a property, which people used to. So you just need to be mindful about how much money you need to put in to make that calculation work. That's, again, a standard calculation. Other banks do different things, but if you're in that starting point, then you're in a good place. Also, you need to have your eyes open to the tax position. There is additional stamp duty to pay right now, and you can't offset all the income tax as well. So just have a good detailed look about that and make sure you're completely au fait with all the costs going in and out, because unfortunately it's a lot more complex than it used to be. Thanks
very much for that, Richard. We need to take a commercial break now, but don't go away. Please join us after the break. We'll be discussing where the UK mortgage market is going moving forward. Welcome back to Proper Wealth with me, Paul Mahoney. I'm joined again by Richard Campo from Rose Capital Partners. Before the break, Richard shared with us his views on some of the changes in the residential mortgage market and interest rates and things. What I'm going to do now is ask Richard to get out his crystal ball. Tell us where he sees rates going over the next few years, given they have just risen. So Richard, over to you. Tell us where rates are going.
Well, I can, but I think the Bank of England are actually a better guide. Mark Carney, since he came in as the Governor of Bank of England, has been very big on something called forward guidance. So literally telling the market what to expect. So in the minutes of the last Bank of England meeting, there was a strong indication to expect something like 3 base rate rises over the next 2 years. So the Bank of England typically rises rates at 0.25%. So we're starting at 0.5% today. So what's that? Another sort of 0.75 on top. So probably in 2 years' time, the Bank of England base rate should be circa sort of 1.25%. So that's a very, very gradual increase. So again, the whole part of this forward guidance thing is just so there's no surprises. Now things change. I'm sure if inflation keeps picking up the way it is at the moment, they might review that. If Brexit gets a bit messy or not what we want, so they might review that again. But as we sit today, as things stand, that's broadly the outline.
Thanks for that, Richard. Very logical. I'd say quite a bit better than a crystal ball educated guess. Based upon that, though, where do you see the UK mortgage market going over the next few years? Based upon your experience, what you've seen in the past, and given the changes we've already discussed, where is it going from here?
Yeah, I think it's quite positive, really, the mortgage market going forward. I think the conversations we have with banks is really how can we lend more. So we've really seen this since the credit crunch, is the market's actually very, very simple at the moment. There's a real lack of innovation, and that's been sort of a problem getting people into the market. So really most banks are looking at more innovative ways they can do things, how they can structure deals differently, and really looking at clients and what they're more suitable for them. And we've seen that in just such a dramatic increase in products. I think at the lowest point in 2008, there was something like 4,000 mortgage products available. Currently, there's over 17,000. So that shows you, in what is relatively a short time, a massive increase in choice, but banks still want to go further. Most banks this year aren't hitting their targets. Banks want to lend more than they are lending. So again, it's really about how they can do that in the right shape, how they can navigate all the regulation, because banks want to lend, people want to borrow. So it's just trying to find that point that's best suited for everybody.
That's a very interesting point there, Richard, with regards to banks wanting to lend more. Richard, what would you say is the most common question that borrowers have when it comes to getting a residential mortgage?
I think probably the most commonly asked question to most advisors is how much can I borrow? That's normally the first thing people come out with. So just that as a starting point, the Bank of England actually sort of set a guideline on this. So most banks are willing to go to around about 4.5 times your income, and that whether it be single or joint. And in fact, some banks now will actually include up to 4 people on an application. So what we're finding, because it's difficult to get into the market, is that people are sort of clubbing together, so friends, couples, and adding other incomes as well, because that's often the best way to get into the market. That benchmark around 4.5 times income came about because the Bank of England wanted to sort of slow down lending a bit because they're worried the market was overheating. So any new bank cannot do more than 15% of its new lending above 4.5 times income. So that's why that became a bit of a benchmark. Now, because it obviously can't be more than 15%, by virtue of that, banks can go over and above that figure. But it just gives you a bit of a benchmark to work with. So pretty crudely, if you know what you earn, 4.5 times that. Quite a positive change as well around the affordability piece is people who have bonuses or commission income. So most banks will include, if you've got, say, certainly a 2-year track record, you can include 100% of your bonuses and commission as well, which dramatically increases your borrowing potential. If you're self-employed like myself, it is a bit more complicated, but again, it's been some really positive moves around that, because banks actually understand if you're looking at your net income, actually your borrowing capacity is far greater than someone on a PAYE, for example. So again, there's multiple ways we can go into that, which I won't bore you with, but banks will look at things like your net profit, your profit on ordinary activities before tax. That's just probably the truest measure of profitability of your company. And again, companies aren't always just a big company, such as the one we work for. It could be that you set yourself up as a sole trader or a contractor. It could be any one of those sort of setups. Certainly the contractors as well. Probably the other sort of segment that we deal with is most banks will now take your daily rate and then apply that. So what banks would do commonly is take your daily rate, times it by 5, times it by 46, and then apply the multiple of 4.5 times on top of that. So people typically are either employed, self-employed, or a contractor. So if you're worried about sort of what you can borrow, play around that figures. That gives you a good benchmark. Again, you can go above or below that certainly, but that gives you something to play with.
Thanks, Richard. That's very interesting with regards to the biggest questions that people have when it comes to getting a residential mortgage, especially where you say there how certain people seeking out how much they can borrow, and obviously different lenders and different products will allow you to borrow different amounts. So it certainly says to me that the value of seeking advice and exploring the market rather than going online or just going to your local bank and asking those questions, because you may not get a full scope and you may not be able to borrow as much as you potentially could. Okay, so my next question is with regards to the biggest mistakes that you see people making. It might be things that they don't know that they're doing that might hurt them, or just blatant issues that people make for themselves. What are the biggest mistakes people are making when it comes to getting a residential mortgage?
Well, I would personally say from my experience, and certainly from talking to a lot of other advisors across the market, the biggest mistake people make is not protecting their mortgage. Because interest rates are ultra low right now, as we said before. The Bank of England's at 0.5%. So it's very common you'd get mortgage rates starting with a 1, which is ridiculous. When I started again in 1999, if you got a mortgage rate starting with a 5, that was brilliant. So the affordability bit is easy. So the biggest mistake you get is not protecting your mortgage. Certainly, again, being based in London, we see this, and we see this particularly with more successful people. It's sort of Superman syndrome. They think it won't happen to me. But to be crude, Superman ended up in a wheelchair, so it can happen to anybody. You have to sort of be realistic about yourself and what's going to happen in the longer term. So I would genuinely say, is just think about the long term, think about your plans, think about your family, because the big mistake is not planning for the future. And again, that goes right down to the extent of actually not buying at all, which I think is a huge mistake people make. I'll challenge anyone to do this. If you look at house prices off the land registry over the last 10 years, there isn't a period where house prices have gone down. It just doesn't happen because there's a chronic lack of supply of property, and there's inflation in our economy, which is currently running at 3.1%. So you put a lack of supply, inflation, and then increased demand, which we're going to get next year because of the stamp duty changes. There's only one way prices are going to go in the longer term. So if people think they'd be clever and outplay the market, you simply don't. So I'll just urge people, buy as soon as you can, that's affordable and within your means, because if it's a long-term bet, you tend to do quite well out of it. If you try and sort of ride any market, the property market's fairly stable. It's like the stock market. You can't second guess these things. And don't treat your home as an investment. Because think about the alternative. If you're not going to buy a home, you have to rent or live with your parents. That's money down the drain every single month. So if you calculate how much you spend in rent or spending to your parents, and you convert that into what you get in a property, I just can't see a situation where you're going to lose in that. And ultimately, what you don't want to do is get to the point where you're retired and you don't own your home, because then you're dependent. I know it's sort of not a very sexy thing to talk about is retirement and planning for that, but you do need to think about it because that's ultimately what's going to happen to all of us.
Okay, Richard, you mentioned before about banks changing the lending criteria and allowing more people to be on the mortgage. So not just one or two people being a couple, which is the fairly traditional way of getting a residential mortgage, but whether that be friends or family buying together. Can you talk to me more about that and some of the complications that can be had there if people fall out or if they break up? How does that work?
Yeah, that's the big problem, having multiple people on an application. Typically, it tends to be friends. We see it in the main that, say, 3 or 4 friends will club together and buy a property. What is really important, again, this is all part of sort of forward planning and why you need good advice, is you can preempt the situation, because at some point, if it's friends or even family for that matter, at some point you're going to sell that property or you might want to get out. So what you can do is get something like a deed of trust set up. That's a legal document, sits with the solicitor, really, really simple thing. And it just counterbalances those situations. So if I want to move out, what happens? If I want to sell, what happens? It's best to always do that at the front end. It's like fixing your roof when it's sunny. Do it at that point, because if you don't think about these things, multiple people do go into it and have different agendas at different times in their life. You do really want something that you can refer back to and say, look, we agree that in this time, and that just completely negates everyone falling out over that.
Much for that, Richard, and I absolutely agree. When it comes to financial arrangements, buying property, getting mortgages, you do need to be very commercially minded and realise that sometimes relationships break down, so you need to cover yourself from a legal standpoint and make sure you have a very clear understanding of what would happen in that circumstance. We've actually run out of time, unfortunately, but thank you very much for your time, Richard. I'm sure you'll join us again soon. I think we've covered the current UK mortgage market quite well, and some of the changes and also some projections of what might happen in the future. But to the viewers, thanks very much for joining us again, and join us next time for more discussions on wealth creation with me, Paul Mahoney, on Proper Wealth.